Your neighbor just retired. Nice guy. Worked at the same company for 30 years. Has the paid off house, the 2 cars in the driveway, the timeshare in Florida. You see him out there watering his lawn at 10 in the morning on a Tuesday and you think, that's what success looks like. He made it. But here's what you don't see. He's got maybe $150,000 in his 401k. His social security check is $1,400 a month. And he's trying to figure out how to stretch that for the next 25 years while his wife needs a hip replacement that insurance won't fully cover. That's not retirement. That's a slow motion financial panic attack with a lawnmower. Everyone talks about hitting $1 million for retirement like it's this finish line. And look, $1 million is impressive. But in 2026, with the cost of everything from eggs to MRI scans doubling every decade, $1 million buys you maybe 15 years of modest living if you're careful and lucky. So the real number, the one that actually lets you sleep at night, is $2 million. That's the figure where you can take out $80,000 a year using the 4% rule, add in Social Security, and actually live without checking your bank balance before buying groceries. But here's the part that's gonna mess with your head. Almost nobody gets there. And I don't mean most people fall a little short. I mean, the percentage of American households with $2 million specifically in retirement accounts is so small, it makes red-haired people look common. I'm gonna show you exactly who has $2 million saved, why it's rarer than you think, and what that means for your own financial future. Because the gap between what people believe about retirement and the actual numbers is so wide, you could drive a Winnebago through it. And most people don't figure this out until they're 58 and staring at a balance that should have another 0 on it. Here's the thing about retirement savings in America. It's like a race where 98% of people don't realize they're competing until mile 20 of a marathon. By then, the people who started at the gun are so far ahead you can't even see them anymore. That's my metaphor for this whole thing. Retirement savings as a race. Except it's a race where the starting gun goes off at 22 when you get your first real job. The finish line is at 65, and most people are still tying their shoes at 35, wondering when things get serious. Let me give you the number that should be tattooed on every financial advisor's forehead. According to the Employee Benefit Research Institute analyzing Federal Reserve data, just 1.8% of American households have $2 million or more in retirement accounts. Read that again. 1.8%. That means if you lined up 100 households, maybe 2 of them hit this mark. We're talking about money in 401ks, IRAs, and other tax-advantaged accounts. Not your house, not your Tesla, not your collection of vintage watches. Cold, investable cash that will fund your life when you stop working. Now, here's where the psychology gets interesting. Most people hear 1.8% and think, well, that's the rich people, the executives, the lucky ones. But that's not quite right. That 1.8% includes households, meaning 2 people combining their savings. So when we talk about individual Americans with 2 million in retirement accounts, the number gets even smaller. We're talking about an elite group that's rarer than people who've climbed Mount Everest. There are more astronauts than people in this club. I spent 10 years running my own business, sitting in rooms with accountants and fiscal lawyers who manage money for people you've never heard of. The ones who quietly retire at 60 with 8-figure portfolios. And you know what they all have in common? They started treating retirement savings like a utility bill at age 25. Non-negotiable, automatic, boring. Meanwhile, everyone else treated it like a New Year's resolution. Important in theory, forgotten by February. But now you might be thinking, okay, 1.8% have 2 million in retirement accounts, but what about total net worth? Surely more people are worth 2 million when you count everything. And you'd be right. About 7% of American households have a net worth over 2 million when you include home equity, businesses, cars, brokerage accounts, the whole pile. That's still not huge, but it's roughly 4 times higher than the retirement account number. Here's why that gap matters. And this is where people screw up their thinking completely. Having a $2 million net worth feels impressive. You worked hard. You made smart decisions. Your house appreciated. You built something. But net worth and retirement income are two completely different animals. If your house is worth $900,000, congratulations. You still need somewhere to sleep. You can't pay your electric bill with equity unless you're taking out a reverse mortgage. And I've read those contracts. They're designed by people who understand compound interest way better than you do. Let me tell you about a guy I know. We'll call him Rick. Rick is 63. He's got a house worth $1.2 million in a nice suburb. He's got 2 cars paid off, maybe 40 grand each. He's got some collectibles, some tools, a nice workshop. On paper, Rick is worth about $1.5 million. Sounds pretty good. Except Rick's actual retirement account has $85,000 in it. That's it. When Rick retires in 2 years, he's going to take out about $3,400 a year from that retirement account using the 4% rule. Add his Social Security, about $2,000 a month, and Rick is living on about $30,000 a year. In a house that costs 12 grand annually, just in property taxes, insurance, and maintenance. Rick is house rich and cash poor. He worked his whole life. He made good money. He just poured everything into the house thinking that was his retirement plan. Now he's trapped. He can't move because he loves that house. He can't access the equity without borrowing against it at 5% interest. And he's about to discover that retirement on $30,000 a year is not what the brochures promised. Rick is not in the 1.8%. Rick is in the 98.2% who are going to spend their retirement years doing math in their head before buying coffee. The median retirement account balance across all American households right now is $87,000. Let me repeat that because it sounds like a typo. $87,000. That's what half of all American households have saved for what could easily be 20 or 30 years of retirement. If you retire at 65 and live to 85, that's $4,350 per year. That's $362 per month. You can't rent a parking space in most cities for that. But here's where it gets darker. These aren't the bottom 10% of earners. This is the median. Half of all households have less than $87,000. These are people who worked full-time jobs, paid their taxes, did everything society told them to do, and they're heading into retirement with less money than a decent used car costs. Now let's look at the people who are actually at retirement age right now. For households headed by someone between 65 and 74, the people who are literally retired or about to be, the median retirement savings is $200,000. That's better than $87,000? Sure. But using the 4% rule, $200,000 gives you $8,000 a year to live on. Add Social Security benefits, which average about $24,000 a year for an individual, and you're looking at roughly $32,000 in annual income. That's tight. That's ramen for dinner tight. Especially when healthcare costs for a retired couple can easily hit $12,000 to $15,000 a year. Here's the story nobody wants to tell. My dad's friend Jerry retired in 2020. Jerry had been a middle manager at a manufacturing company for 35 years. Decent salary. He always figured he'd be fine because he had his pension. Except the pension got frozen in 2009 after the financial crisis, and it pays him $1,100 a month. Jerry's got about $160,000 in his 401k. He thought he was set. Within 6 months of retiring, Jerry realized he couldn't afford to retire. He's back working part-time at Home Depot. Not because he loves helping people pick out tile, because his math didn't work. Jerry is 71 years old and wearing an orange apron because he's in the 98.2%. This is where the race metaphor comes back. Jerry thought the race was about making it to 65. He didn't realize the race was about accumulating enough assets that your money could run the rest of the race for you. The 1.8% who have 2 million figured this out early. Their money is running the race while they sleep. Jerry's still on the track, and he's 71. But now you're asking yourself, what actually separates the 1.8% from everyone else? It's not luck. It's not inheritance, though that helps some people. It's the difference between having liquid invested assets versus having your wealth locked up in things that don't generate income. $1 million investment portfolio works for you 24/7. It compounds. It grows. It throws off dividends and capital gains. The S&P 500 has been on a tear. 26.3% in 2023, 25% in 2024. Year to date in 2025, we're up about 14.9% through Q3. If you had $1 million invested at the start of 2023, you'd have nearly 1.7 million by now without adding a single extra dollar. That's the power of having money in the market versus having it tied up in your house. Your house appreciates at maybe 4% a year on average across the United States. Some markets do better, some worse, but 4% is the historical norm. The stock market's long-term average is about 10% annually. Over 30 years, $100,000 invested in real estate at 4%, growth becomes about $324,000. That same 100 grand in the S&P, 500 at 10%, becomes 1.7 million. The difference is not subtle. And here's the kicker. You can't access your home equity without either borrowing against it, which costs you interest, or selling and moving somewhere cheaper, which comes with all kinds of lifestyle disruptions. Your investment portfolio? You can withdraw from it whenever you need it. It's liquid. It's working for you. That's why the 1.8% have their wealth in retirement accounts, not just locked up in their 4-bedroom colonial. Now, most people think the math to get to 2 million is impossible. They see that number and assume you need to be making 200,000 a year and living like a monk. But the actual math is way less intimidating than you think. And this is where most people's brains break because they've never sat down and actually done the calculation. Someone starting from zero needs to invest about $14,000 per year for 36 years to hit 2 million, assuming a 7% inflation-adjusted return. That's $1,170 per month, or about 16 to 17% of median US household income. Start at age 30, you hit 2 million around 65. Start at 25, you only need $835 per month. Wait until 40, now you need $2,500 monthly. Start at 50, you need almost $5,000 per month. That's nearly 60 grand a year. For most households, impossible. Time is everything in this race. The earlier you start, the less painful it is. Every year you wait makes the monthly nut bigger until eventually it becomes mathematically impossible unless you're making serious money. Here's what's wild about compound growth. And this is the halfway point where everything clicks. Once you hit $500,000 in retirement savings, you're basically on cruise control to 2 million, even if you never add another dollar. The S&P 500 doubles roughly every 7 to 8 years at 10% annual return. So 500,000 becomes 1 million in 7 years, then 2 million in another 7. Let's say you hit 500,000 by age 50. You could have 2 million by 65, just from compound growth. No additional contributions. That's the secret the 1.8% understand. The first 500,000 is the hardest. After that inflection point, your money makes more money than you contribute. Most people quit before they hit that inflection point. They get discouraged watching slow growth in their 30s and 40s. They don't see the exponential curve coming. They never experience the magic of the second million coming faster than the first. But here's the problem, and this is the actual crisis. Most people don't contribute consistently. Life gets in the way. You lose your job and pause contributions. Kids arrive and diapers cost 4 grand a year. You buy a house and the mortgage eats 30% of income. Medical bills pop up. Student loans hang around like a bad smell. Every time you pause retirement savings, you're not just missing that contribution, you're missing decades of compound growth on that contribution. A $500 contribution you skip at age 30 could have been worth $5,000 by retirement. But here's what's even worse. When income rises, most people increase their lifestyle instead of their savings rate. I watched this happen to a buddy of mine. He got a $10,000 raise at 32. Know what he did? Upgraded his apartment from $1,400 a month to $2,000. Bought a nicer car, started eating out more. His 401k contribution stayed at 6%. That extra 10 grand a year could have been going into retirement accounts for 33 years. At 7% growth, That's about $1 million he traded for a nicer apartment and a car that's now worth 8 grand. The 1.8% who hit 2 million do the opposite. They keep living like they earn less and funnel every raise straight into investments. Picture this. 2 coworkers, both 30 years old, both making $70,000 a year. Sarah starts putting 15% of her income into her 401k. That's $10,500 a year. David puts in the company match minimum 6%, about $4,200 a year. They both get the same raises over their careers, averaging 3% annually. Sarah keeps her lifestyle flat and increases her 401k contribution with every raise. David increases his lifestyle with every raise and keeps his contribution percentage the same. By age 65, Sarah has about 2.3 million. David has about 870,000. Same starting salary, same raises, same company, different psychology. Sarah is in the 1.8%. David is in the 98.2%, wondering how Sarah retired early. Now, here's the escalation that nobody wants to talk about because it sounds too much like doomerism, but I'm looking at the actual data here. Social Security, the thing everyone's counting on to save them, is running out of money. The Social Security Trust Fund is projected to be depleted in 2033. That's 7 years from now. When that happens, federal law requires an automatic 23% benefit cut across the board. Let me translate that into dollars. For a retired couple currently receiving the average Social Security benefit of about $48,000 a year combined, a 23% cut means they lose about $11,000 annually. That's rent money. That's healthcare money. That's the difference between scraping by and actually being broke. Back in 2000, there were 3.4 workers paying into Social Security for every beneficiary receiving benefits. Today, that ratio is about 2.7 workers per beneficiary. By 2035, it's projected to fall to just 2.3 workers supporting each retiree. The math doesn't work. You can't support a growing population of retirees with a shrinking workforce unless you dramatically increase taxes, which nobody wants, or cut benefits, which nobody wants, or raise the retirement age, which nobody wants. So we're just pretending the problem doesn't exist while the clock ticks down to 2033, and it gets worse. Medicare's Hospital Insurance Trust Fund is also projected to be depleted in 2033, same year. When that happens, the law requires an 11% cut to hospital payments. Hospitals might start refusing Medicare patients if the reimbursement doesn't cover costs. Access to care could become a real problem. So you've got Social Security getting cut by 23% and Medicare getting cut by 11%, both hitting at the same time, right? When Gen X and younger boomers need these programs most, the safety net everyone's been counting on is fraying in real time. This is why that 1.8% number is so critical. The people who have 2 million in retirement accounts aren't relying on the government to save them. They built their own safety net. They understand that Social Security should be supplemental income, not the foundation. But for the 98.2% who didn't save enough, those programs are the difference between surviving and going under. When those benefits get cut in 7 years, millions of people are going to find themselves in serious trouble. The writing is on the wall in 14-point font, and most people still aren't reading it. Let me show you what 2 million actually feels like in your account when you retire, because this is where theory meets your actual bank statement. Using the 4% withdrawal rate, which is designed to make your money last 30 years, while adjusting for inflation, a $2 million portfolio generates about $80,000 per year. That's your base income from investments alone. Add Social Security benefits for a married couple, roughly $48,000 per year combined, and you're looking at total annual retirement income around $128,000. That's comfortable. Not private jet comfortable, but you can cover living expenses, pay for healthcare, travel twice a year, help the grandkids, and handle unexpected costs without constant stress. Now compare that to the median household we talked about earlier. $200,000 in retirement savings generates $8,000 a year. Add Social Security and you're living on maybe $56,000 per year for a couple. That's survival mode. You're not traveling. You're not helping anyone. You're trying to keep the lights on. The difference between 56,000 and 128,000 per year is the difference between existing and actually living. One is counting pennies at the grocery store. The other is buying the organic strawberries without checking the price. But here's what traps people every single time. And this is the psychological shift that separates the 1.8% from everyone else. You have to stay invested through the scary parts. During the 2008 financial crisis, the market dropped nearly 40%. People panicked, sold everything, locked in their losses. Then they sat on the sidelines in cash while the market recovered and went on to absolutely demolish previous highs. Those people permanently destroyed their retirement because they couldn't handle seeing their balance drop. They made the worst possible decision at the worst possible time. The S&P 500 has had plenty of negative years, 4 times in the 2000s alone. But over the long term, it always recovers and reaches new highs. Always. Since 1950, if you held for any 20-year period, you made money every single time. But most people don't have the stomach to ride out a 30% drawdown. They see their 401k drop from 600,000 to 420,000, and they freak out. They go to cash. They tell themselves they'll get back in when things stabilize. Except by the time things feel stable, the market's already recovered and they miss the entire rebound. That's how you end up broke in retirement. Not because the system doesn't work, because your brain gets in the way. I've got multiple hundreds of thousands of dollars invested right now. I've watched my account drop 20% in a month during corrections. It feels terrible. Your stomach turns. You want to do something. But doing something is usually the mistake. The 1.8% who hit 2 million learn to sit on their hands during crashes. They understand that volatility is the price you pay for long-term returns. The 98.2% treat volatility like an emergency and make permanent mistakes with temporary problems. Here's a mini case study with real numbers. Meet Jennifer and Mark. Jennifer is 35. She makes $85,000 a year. She started contributing 15% to her 401k at 25 and has never stopped. Her balance today is about $230,000. She's on track to hit 2.4 million by 65. Mark is also 35. He makes $90,000 a year, more than Jennifer. He started contributing to his 401k at 31 because he wanted to pay off his car first. He contributes 10%. His balance today is about 68,000. He's on track to hit about 900,000 by 65. Jennifer will be in the 1.8%. Mark will be in the 98.2%. The difference isn't their salaries. It's when they started and how much they prioritized it. Jennifer drives a 10-year-old Honda. Mark drives a 3-year-old BMW. Jennifer takes 1 vacation a year. Mark takes 3. Jennifer has no consumer debt. Mark has 15,000 on credit cards. In 30 years, Jennifer will retire early and travel the world. Mark will work until 70 and hope nothing breaks. Same generation, same city. Different priorities, different outcomes. That's the race. Jennifer started running at mile 0. Mark started at mile 5, and he's running slower. You might be thinking, okay, this is all depressing, but what do I actually do about it? Fair question. Here's the 3-level framework that actually works. Level 1, automate your savings before you see the money. Set up your 401k contribution to happen automatically with every paycheck. You can contribute up to $23,500 in 2025 if you're under 50, or $31,000 if you're over 50. Max it out if you can. If you can't max it out, at least hit the company match, then increase your contribution by 1% every time you get a raise. You won't miss money you never see. Level 2, invest in boring index funds and never touch them. The S&P 500 has outperformed 90% of actively managed funds over 20 years. You don't need to pick stocks. You don't need to time the market. You need to buy the index and forget about it for 30 years. Boring wins. Complexity loses. Every piece of data I've read from SEC filings and academic research says the same thing. Low-cost index funds beat almost everything over long periods. Level 3, increase your income and keep your lifestyle flat. This is the hardest one because it requires discipline. Every raise you get, every bonus, every side project that makes extra money, put 75% of it into retirement accounts. Live on the remaining 25% increase. If you make $70,000 and get a $10,000 raise, take $80,000 in spending and put $7,500 into your 401k. Your lifestyle still improves, but your future improves way more. The 1.8% mastered lifestyle discipline. The 98.2% let lifestyle inflation eat every raise. Here's the truth nobody wants to say out loud. The system is broken for most Americans. But it doesn't have to be broken for you. The path to 2 million is clear. Start early, save consistently, invest aggressively in index funds, stay invested through downturns, max out your tax-advantaged accounts every year. And whatever you do, don't fall into the lifestyle inflation trap that catches everyone else. The difference between the 1.8% and everyone else isn't luck. It's not inheritance. It's discipline, consistency, and time. You still have time if you start now. The question is whether you're actually going to do it or whether you're going to be my neighbor watering the lawn at 72 because your 401k ran out. The race is happening right now. Most people are still in the parking lot wondering when it starts. The 1.8% are already at mile 20, and their money is carrying them to the finish line. You can either get in the race today, or you can spend your 70s wearing an orange apron wondering where it all went wrong. Because here's the final thing I learned sitting in rooms with accountants who manage 8-figure portfolios. Lazy investing built more fortune than crypto memes. Boring index funds, automatic contributions, decades of compounding. That's what the 1.8% did. Nothing sexy, nothing complicated, just math and time and the ability to not screw it up when their brain told them to panic.